Well, folks, this is absolutely scary what we're about to get into in this video here today, folks. This is insane. It's like trying to flip a flapjack, but you miss the pan and it falls on the floor and you're like, no, okay. This is awful. In all seriousness, why the housing market should brace for double-digit mortgage rates in 2023. We're talking in February. Now, this is a shocking prediction that I really haven't heard out there, to be honest, about double-digit mortgage rates. Like, that's insane because, people have gotten very used to, for years and years and years, of mortgage rates anywhere from the high 2s to the low 4s. So when all of a sudden you throw, and this is in a matter of months, it hasn't been like this is years and we got to this place, right? In a matter of months, we've went from, you could get at the beginning of this year, think about this for a moment. At the beginning of this year, you could get a mortgage with at a 3% rate for a 30-year. That was very common at the beginning of this year. Now we're at a point where we are talking about, we're at 7% and we're talking about going to 10% plus within a few months here. That's insane, right? So I want to get into this. I want to react to this. I want to read through their points in this video here today. And I want to talk about, if this does happen, the type of devastation to expect out there in the economy, which is absolutely frighteningly scary if this does play out. Hope you guys enjoy this. As always, I appreciate each and every one of you that's subscribed to this channel, which now we are over 17,000 flipping flapjack and subscribers. So it's a holy smokes. This ain't no joke, because I appreciate each and every one of you that subscribe to the channel. If you ever want to say hello to me, send me a DM on IG, okay? Alrighty, so even if Federal Reserve Chairman Jerome Powell and his cohorts, I can never pronounce that word right, stopped hiking policy rates soon, which is definitely a possibility here in a few months, the 30-year fixed mortgage rate still would climb to 10%. According to Christopher Wallen of Wallen Global Advisors. That's because the Fed's torrid pace of rate increases in 2022 takes time to seep back into mortgage rates, especially with the Fed funds rate already jumping to 3 to 3.25% range in late September from almost zero a year before. Lenders only slowly adjust their rates, Whalen told MarketWatch. They are not used to seeing rates moving this fast and typically would change rates only once a month or once every other month. Okay. That's a little scary there, okay? Borrowers pay premium above risk-free treasury rates on mortgages to help account for default risk. The 30-year treasury rate is about 4.34% right now and rose to 4.2% Thursday, its highest since 2011. Wow. Freddie Mac on Thursday said the 30-year mortgage was averaging 6.94% in its latest weekly survey, a 20-year high that has severely curtailed demand for new homes. Yeah, we'll talk about that in a moment, okay? But with U.S. inflation showing no signs of a clear pullback from a 40-year high, expectations have been running high for the Fed to increase policy rate by another 75 basis points in November. And that's, I would say, almost 100% probability, to be honest. And potentially the same amount again in December, which is scary because, a lot of folks were thinking maybe 0.25% stuff. Now you talk about another 75 basis points in December also. Oh my gosh, okay. That's scary. And also, scary for obviously the stock market as well. So, you look at it, this two sides if you're thinking about the stock market angle, right? One is now the expectations almost going to 75 basis points in December. So if it comes in with less, maybe that's a good scenario for the markets, obviously, right? The CME odds on Thursday favored a 4.75% to 5% Fed funds rate kickoff in February. Okay, so that's where we're expected to be at for Fed funds rate in February, roughly. It's expectation now at this point. There is a lag effect in mortgages, Whalen said, adding that even if central bankers decide to hit the pause on additional rate increases after their December meeting, the 30-year mortgage would still easily touch 10% by February. Now, the comment is important. The word choice is important that this gentleman's using here, okay? Easily touch 10% by February. Real estate's done if that happens, okay? I mean 100% done if that happens. The economy is done if that happens. That is devastating. I'll explain why and why this matters in such a significant way in just a moment here, okay? Whalen, an investment banker, author, and specialist focused on banking and mortgage finance, urged the U.S. Securities and Exchange Commission in 2008 to move complex and opaque derivatives back into daylight after the banks and investors saw hundreds of billions of dollars in losses tied to structured debt, including subprime mortgage exposure. He also provided testimony to Congress in 2009 about systemic risks in the banking industry. Okay, it's impressive. Now Whalen sees another major shakeout coming in mortgage banking as profitability continues to get pinched and the housing market sputters. And yeah, it looked like it went from it doesn't take a rocket scientist to figure out, it went from great to bad and probably getting worse over the next few quarters here. Okay. Importantly, Whalen sees potential for home prices. This is big here. Home prices to give back all their pandemic gains if rates stay high for all of 2023. Wow, that's a big statement there because obviously there's tremendous gains seen, right? And I've definitely seen it, at least in my market, Vegas, that we've given back a lot of the true gains already. You don't see it as much in the numbers, but that's because a lot of homes aren't selling. So people are trying to sell them and they're trying to drop prices, but they're not moving. So they're not really hitting the data yet. They'll hit the data much more over the next 6 and 12 months, and you'll see like prices move down in quite a considerable way. But to give up all the gains, that's a pretty big statement. But if we think about it from the stock market angle, right? What have we seen as of last week? This week we came back a little bit, but as of last week, here's where we stood. The Russell had lost all its gains. It was actually negative from where it was prior to Rona. The Dow was right around break even. The NASDAQ had a very, very slight gain, and S&P 500 had a very slight gain. And that was as of last week, okay? Now think about it for a moment. The stock market lost all that value. Who's to say the real estate market can't lose all its value, right? It's definitely a possibility, and we know real estate lags the stock market. So the stock market's always 6 to sometimes 24 months in front of the real estate market. And it just depends upon the time. It's always at a minimum 6 months, but sometimes it can be as much as 2 years. And so the market can make a massive downward move while real estate's potentially going up. Vice versa, the stock market start moving up in a major way while real estate continues to drop and get worse and worse and worse, which is actually what I think is going to likely play out in this scenario. It's very similar to what happened in the great financial crisis, where the stock market started to come back a long time before real estate started to come back, okay? And so that's some food for thought there. That's a big statement. It's a big statement to have 10%. It's another one to say, you know, we could potentially get back all the gains of Rona there, okay? That's a bigger call than the estimate for a 10 to 15% correction in home prices that have surged 45% nationally during the pandemic. But Whalen pointed to speculative home flipping volumes that reached almost $150 billion, or 10% of total home sales in 2022. Why were people doing that? Why did home flipping all of a sudden go crazy, right? Well, it was easy money. Whenever home prices appreciate at a rapid clip, you're going to get massive amount of flippers coming to the market. And the reason being is it's just there's so much easy money there. And so that's what happens, right? It's no different than the stock market. If the stock market's just going up and up and up in a very quick amount of time, right? All of a sudden it starts attracting more and more traders and people saying, I want some of that quick money. Because it looks like it's easy money, it's quick money, right? Home flipping is the same exact situation. And there's definitely a lot of home flippers that if they're over leveraged right now and they're holding a bunch of properties, they are not in a good position, okay? And I actually talked with one a couple months ago, and he was scared. I'll just put it that way. Of 10% of total home sales in 2022, in the cold blanket of double-digit mortgage rates as catalyst for steeper home price retreat, economists from Mizuho Securities on Thursday pegged median home sales prices as down 2.5% from their peak. In a client note, as characterized the housing market as deteriorating, but mostly in line with expectations given the sharp jump in mortgage rates. Mortgage loan rates can be traced directly to mortgage-backed securities, or MBS. Mortgage loan rates can be traced directly to mortgage-backed securities, or MBS, which are bonds that trade on Wall Street, mostly with government backing, that finance the bulk of the near $13 trillion U.S. mortgage debt market. With the Fed's race to raise rates, it has jolted financial markets, sunk stocks, and led to a stark decline in mortgage bond insurance this year. while also making it more expensive for corporations, municipalities, and households to borrow as part of the inflation fight. That's the thing. It's like everything's getting hit, and the entire credit market's in a much, much tighter condition now at this point in time than kind of the loose place we were a year ago, 2 years ago, where it was just like, a flood of kind of money out there, right? It will take us months to get the bond market and lending market in sync so people can make money again, Whalen said. Now, folks, why this is going to be devastating to the overall economy if this plays out. And, the hope is that mortgage rates could start going down again around the first quarter, second quarter of 2023. If that doesn't happen, okay, and we are even at 7%, but especially if we're talking about 10% plus, it's going to be devastating to the overall U.S. economy. And so when I see some people get very excited about the opportunity of like home prices going down and those sorts of things, but they don't understand the devastation of the economy. They don't understand the amount of people that are going to go on food stamps in a situation like that, on government assistance, what that's going to do to the national debt as if weren't already in a bad enough place, what it's going to do deficits. People don't think about these things deeply enough, okay? Here's how this plays out. If we were talking about those sorts of mortgage rates, what you're going to see is mass cancellations on homes that are being built right now, which there's right around a record number of homes being built right now, okay? People will just be able to cancel contracts because they won't be able to afford it. The mortgage rates will be way too much, okay? Second part of that is, guess what? No one's going to buy new homes, right? There's millions of jobs that are dependent upon in the United States of America that are direct or indirect affected by the real estate market. All the folks that build the homes, all the folks that sell products that for the homes to be built, right? I'm just recording this in a garage right now, right? Somebody says a garage door company in the United States of America that has been thriving over the last few years selling garage doors, right? If all of a sudden homes aren't being built, that garage door company is going to have to cut off massive amounts of jobs, right? That person that sells that fancy light right there, right? They're not going to make that money. In the store I bought that from is not going to make money, which means they have to cut jobs. And so you could just go through your house, go through your apartment, whatever it is, okay? And you can see there's hundreds of businesses and companies that usually make some sort of money off of a new home being built. As soon as new homes aren't being built anymore, and here's what I found in the data based upon what I see at home builders. Home builders are good till about the second quarter of 2023 with backlog, okay? After the second quarter of 2023, almost all these home builders' backlog dries up, okay? What does that mean? That means essentially the home builders, then all their contractors they use aren't going to have new homes to be built, which means all those contracting companies are going to go belly up, or they're going to have to do mass layoffs, which means people are out of work, which means then those people have to try to find other jobs. And if we are in that sort of bad economic environment, it's not easy like you just get a job, right? Which means the amount of people on food stamps goes up massively, the amount of people on government welfare goes up massively, everything gets massively worse for the economy. Those people that had good jobs, right, now can't afford to go spend money at that restaurant or go spend money over here in the economy or go buy a new iPhone or do this or do that, right? Which is devastating to obviously the overall economy. And that's why this is such a scary dynamic that I'm looking at and I'm like, this is why this is my biggest fear going into 2023 outside of geopolitical events, right? In that whole situation in China, Taiwan, and everything, that's going on in Europe, obviously, right? My biggest concern is the real estate market. My biggest concern going into this year, and I remember I used to say this on Millennial Money, everything back, getting in the back half of 2021. My biggest concern for 2022 is the middle class, right? And unfortunately, we've seen the middle class absolutely sliced and diced this year. It's been awful, because of inflation, obviously, right? My biggest concern for 2023 is the real estate market. And if that gets really, really ugly, you just got to understand that's when you talk about an elongated recession. That's when you start to talk about 7 to 10% type unemployment. That's when you start to talk about a slow recovery. One of the reasons the recovery is so slow coming out of the great financial crisis was the real estate market was in a horrible place for like 4 years. The real estate market just entered a horrible place in 2007, and it didn't start to emerge out of that for 4 years later, where you can finally say, okay, we really bottomed here and we're starting to get it in a better place now at this point in time, right? 4 years. And that's just one reason why unemployment stayed relatively high. If you look at the unemployment rate, coming out of the great financial crisis, it didn't just go from 10% back to 3 to 4% overnight. It took years and years and years and years just to get back under 5% unemployment again, right? And that's one of the big reasons was how bad the real estate sector got hit and how many jobs that produces and what that does for the overall economy. It is so big. It's the biggest thing to ever happen to the U.S. economy over everything else is a new home being built. It's the best thing that could ever happen in the U.S. economy by a mile, and it's not even close. A new home being built, which is almost always issued by debt, right, means massive amounts of jobs are created instantly from that new home being built. And when you kill that market, you kill the U.S. economy and you kill spending in general, okay? One of the reasons we haven't seen mass unemployment or anything like that at this point in time, right, is because of the massive backlog in homes being built and what that means for these companies, right? But the scary thing is you start to look at some of these companies' numbers and it's already starting to reflect a little bit, okay? Look at Whirlpool's numbers. They're cutting production big time, right? That's a company that produces massive amounts of jobs, right? In not just the United States, but other markets as well. And if you're talking about a situation where, they're not going to have as much demand in 2023, what do you have to do? You cut production, you cut jobs. That's what happens, right? And all the other appliance companies out there that have made bank over the last few years, a lot of them could be looking at job cuts in a significant way in 2023, right? And production cuts in 2023 if the real estate market gets worse and worse, which is definitely a realistic possibility. And that's why this matters in such a significant way. And that's why you shouldn't just, like I said, a lot of people are just very, in my opinion, borderline arrogant or ignorant in this situation where they're rooting for this and they don't understand what that's going to mean for folks' lives, what that's going to mean for kids, what that's going to mean for food stamps and government assistance and our national debt and our budgets. And if that wasn't already bad enough, it'll get a lot worse, man. So that's why all these, sometimes I even look at what the Fed's doing, right? And they're like, we're going to try to, kill inflation by just keep raising rates, right? It's like, okay, you do that, you likely could devastate the economy, right? You devastate the economy, how are we going to get out of that? Oh, drop rates back down to zero, pump money out there like crazy, right? Massive government assistance, massive government stimulus. Oh, back to the same game again, right? And so sometimes I even look at it and I'm like, is it really worth it? Has the Fed got the price of a gallon of milk down? No, they haven't. They haven't made any progress, to be quite frank. They're raising rates like crazy. The more they raise rates, the more likely they're going to kill the entire economy. And the more you look at that and you're like, oh, they kill the economy. Who's going to bail everything out? Oh, the government and the Fed. And is that healthy, right? Get ready to see more trillions under the federal debt. Get ready to see deficits bigger than ever before, right? That's what ends up happening in this situation. So anyways, guys, hope you enjoyed this. As always, I appreciate, sharing this with you. That's an interesting thought that, home prices could lose all of Rona gains. And talking about 10% plus mortgage rates by February. Love to hear your guys' opinion in that comment section. You think that's realistic or not? I would love to hear from you guys. As always, I appreciate you joining me. Much love as always. And also, once again, if you want to say hello to me, send me a DM on IG. Thanks everybody that's subscribed to the channel. 17,000 plus strong now at this point in time. And have a great day.